Welcome to Lecture 1. We've been through the introduction. I'm now going to go through 5 definitions. What is classical unemployment? Classical unemployment is unemployment resulting from an increase in wages above the free market equilibrium wage rate. Now, what does that mean? Free market equilibrium wage rate. We know that free market is the interaction of demand and supply. So it's where the demand for labour meets the supply of labour. And so classical unemployment is where wages are above this free market equilibrium. Aggregate demand. Aggregate demand is the total amount demanded in an economy over a given period of time. We express it as C plus I plus G plus X minus M. C is consumption. I is investment. G is government spending. X is exports. M is imports. Now, exports is where goods leave the country, goods and services, money, and comes in. Therefore, exports and government spending and investment are all injections into the circular flow of income. Savings, tax, and imports are leakages from the circular flow. It would be helpful to your study if you knew the various factors affecting consumption, investment, exports, and imports, and of course government spending, particularly things like business and consumer confidence, income levels, interest rates, exchange rates. Aggregate supply. Aggregate supply is the total output produced by an economy's firms over a period of time. In the short run, aggregate supply responds positively to changes in the price level. In the long run, the price level is less relevant, and factor productivity, that's land, labour, capital and enterprise, factor productivity determines the level of aggregate supply. So in the short run, if the price level increases, then aggregate supply will extend, more will be supplied. But in the long run, we look at factor productivity. Cyclical unemployment. Remember that unemployment doesn't necessarily mean you haven't got a job. If we are using, for example, job seekers allowance, people who are claiming job seekers allowance as a measure of unemployment, you could be in a part-time job and still officially be unemployed. So cyclical unemployment is unemployment that results from a general decline in economic activity. A recession. A recession is 2 consecutive quarters of negative economic growth. So cyclical unemployment is unemployment that results from a general decline in economic activity, a recession, associated with downturns in the business or trade cycle. It is also called demand deficient, lack of demand, unemployment. Remember that aggregate demand is C plus I plus G plus X minus M. So it is also called demand deficient unemployment and Keynesian unemployment after English economist John Maynard Keynes. Economic growth. Economic growth is a macroeconomic concept which refers to a rise in real national income, which is sustained over 2 consecutive quarters of a year. Stable growth is a key macroeconomic policy objective as it leads to higher standards of living and increased employment. However, there are certain costs of growth, including increases in consumption and production externalities, inflationary pressure, and international trade difficulties. Remember that externalities are third-party effects. You also need to be familiar with how fiscal and monetary and supply-side policy can be used to stimulate economic growth. That completes the definitions for Lecture 1. Great. I would now like you to go to the website and find any 5 definitions you want, put them in the question-answer section for this lecture. And when you've done that, be prepared to be asked questions by me and by other people. Now, don't do that immediately, because I'd now like you to watch this YouTube clip.
We talk about the macro measures. In Unit 2, we're talking about the 3 goals of every economy. Doesn't matter what kind of economy it is, they have 3 goals. They want to grow over time. They want to produce more stuff. They want to keep unemployment down, like limit unemployment. And they want to limit inflation, or at least keep prices stable. That's what you do in this unit. You cover each one of these concepts. How do you measure these different things? And what are the issues with those measurements? And then we move on and apply that stuff in later units. So it starts off with the idea of growth. Growth is the idea the economy is expanding over time. And the most important concept, probably in the entire course, is GDP, gross domestic product. It's the dollar value of all final goods produced in a year in a country's border. So anything you produce in your own country. Now, you should also understand the idea of GDP per capita, which is the GDP divided by population, and get good at doing percent change. So if I say the GDP in one year is this amount and the GDP in another year is a different amount, you should be able to calculate the percent change in the GDP. Now, when it comes to GDP, it's important to know what's not included in GDP. And the first one is intermediate goods. These are goods that go into the production of a final good. So we only count the final good, not the things that went into producing it. So we count the final laptop, not the computer chip that the laptop producer bought from another company. So intermediate goods don't count. Also, we don't count non-production transactions. These are situations where nothing new is produced. So stocks and bonds, they don't count in GDP because we have to count things that are goods and services provided in that year. Nothing old, nothing counted in previous years, that doesn't count towards GDP. And the last one is non-market transactions. So illegal goods or illegal labor, those don't count in GDP either. And there's 2 ways to calculate GDP, even though the most important one for our purposes is usually the expenditures approach. But there's also the income approach. The expenditure approach adds up all the spending on all goods and services in the economy, and that tells you how much we produce in a given year. The income approach adds up all the income earned from producing those final goods and services. So really, it should just be the same number, 2 different ways of calculating it. But it does give us the most important equations. Remember, GDP equals C plus I plus G plus XN. It's a super important concept. Remember, business spending is investment. It's not stocks and bonds. Stocks and bonds don't count towards GDP. Government spending, government can buy stuff, and other countries can buy stuff. Now for net exports, remember, exports minus imports is the net exports. And for the United States, it's actually a negative number. And the income approach also has its own equation. It's made up of rent, wages, interest, and profit. So if you add up all of those, you add up what's called the factor payments, then that should add up to the GDP of the things we produce in a year. Another concept you're going to see is the idea of nominal and real GDP. Remember, nominal GDP is not adjusted for inflation. So when we talk about the economy, we're usually analyzing real GDP because that's adjusting for inflation and showing us what we're actually producing. And a great way to show that is the business cycle. The business cycle shows you there's 4 different phases in the business cycle. When there's a peak, and then when the economy's up there, eventually over time the economy moves towards a recession, and then it falls down to a trough, and then it goes into expansion, goes right back up. The economy goes up and down over time. And that tells you there's only 3 places the economy can be at any given period of time. We can be at full employment. This is the idea that the economy is doing great, GDP is up, real GDP is moving nice and steady. We can have a recession, right? This is a recessionary gap where the economy is not doing well, we have very high unemployment, and we have something called an inflationary gap when the economy is kind of overheating and we're having more and more inflation. You're going to see those concepts later on as well.
And then, when you finish watching it, read through this newspaper article that you will see panning in front of you, but I'm going to give you the link to it anyway. That's it. Wasn't too hard, was it? That's the end of lecture 1. Let's move on to lecture 2.